Hi friends, my name is Chetan and today I'm going to be talking to you about an indicator which is called as moving averages. Moving averages is one of the most popular indicators, and I will give you a quick tutorial as to how you can use moving averages to make your trading or making money in the stock market more effectively. Like I said, my name is Chetan and I am a professional trader. I'm also a teacher of trading, investments and how to make money in the stock markets. I have been an ex-banker from Singapore for last 12 years of my life, and now I currently teach people how to make money in the stock market. I run the following pages on the internet. One of them is called as Investments. It's this one, Investments. It's on Facebook. So if you go to Facebook and if you type in investments, you'll be finding it. I also have 3 blogs. One of them is called as investments.blogspot.in. There is a second one which is called as Funny Fish Market. Yeah, and there's a last one which is called as funnyfishmarket.blogspot.in. So do check it up. I always end up putting up something interesting there for us to develop ourselves as traders, as investors, or increase our financial illiteracy. So very quickly, let's look at this diagram. This diagram represents moving averages. This particular is the price. Now the price has been denoted in candlesticks, so all this are basically the prices in candlesticks. I have drawn 2 moving averages on it. One of them is called as simple moving average, second of them is called as weighted moving average. So the pink one is the simple moving average. This is SMA. It's called as simple moving average, and the blue one is called as weighted moving average. This is weighted moving average. It is also called as WMA, right? Now if you look at it, that both these moving averages which have been plotted are of the same numbers, but there is a difference. Simple moving average is slightly slow to react. Weighted moving average is slightly faster to react, which basically means to say that simple moving average stays away from the price. There is a difference between the price, but weighted moving average actually sticks to the price, right? Simple moving average is away from the price, weighted moving average is closer to the price, which means the sensitivity of simple moving average is lower than weighted moving average. See, this is weighted moving average closer to the price. Simple moving average for the same period is away from the price. We'll try to find out why this happens, and we'll try to find out how we can use this, right? So just wait for some time and I'll explain to you in detail. So moving average is a trend following indicator. Now the reason why we say it is a trend following indicator is because it does not exceed the price, it follows the price. The indicator comes into functionality only after the price has been indicated on the chart. It is one of the most basic and the most popular indicators. Almost everybody uses moving averages. The reason, we'll find out the reason why. It is a slow reacting indicator. It is a lagging indicator. Most importantly, you have to realize there are a lot of people who use moving averages as a trading tool. But what you have to pay attention to is moving average is a lagging indicator. There are 2 types of indicators. There are leading indicators and lagging indicators. Moving average is used to smooth out data. It is an excellent tool to smooth out data. It is basically an average. An average is always used to smooth out data, which means it reduces the volatility in the chart and it helps you out to find out how the volatility can be reduced. The reason why moving average is very popular because it is one of the easiest indicators to construct. It is one of the indicators which was constructed the earliest when technical analysis started. The reason why is because the construction of it is easy. In the earlier days when you did not have computers, the plotting of the chart and the prices had to be done manually, and hence you needed an indicator where you could calculate it easily. What you need to remember most importantly is that it can be calculated based on close, open, high as well as on the low price. Some of them actually use the closing price, some of them actually use the opening price, high as well as the low. Moving averages shows us the direction of the price. You know, a lot of times it happens that we get confused in the market. We don't know whether the market is going up, down or sideways, and moving averages is an excellent way to find out and clear the confusion in our mind whether the market is going up, down or sideways. Yeah, if the price closes above the moving average, it is considered to be a bullish move, and under the moving average it is considered to be a bearish move. It represents the average or the fair price of the stock. Now let us understand, the word is moving average. It is the average price. Yeah, so it represents the average or the fair price of the stock over a period of time, which means if the current price of the stock is above the moving average, then it is going to be considered bullish because people are ready to pay more for the stock. And if it is below the moving average, which means people are not ready to pay as much as the average of the price, and hence it is called as a bearish move. It simply determines whether the buyers are ready to pay more or less than the average price. This is the trick. Price has a tendency of reversion to mean phenomena, which basically means what? If there is a moving average and the price is going above it, the price has a tendency to come back to the moving average, and if the price is going below it, it has a tendency to come back to the moving average. Why does this happen? This simply happens because moving average is considered to be the average. So sooner or later the price is going to guide it towards the moving average, isn't it? One interesting use of moving averages is that it defines for us a potential support and resistance levels. Like for example, this is a moving average, and if the price is above the moving average, which means it is considered to be bullish, it is going to have a tendency to come back to the moving average because it's an average price. And if the price is below the moving average, it has going to have a tendency to come back to moving average again, because again this is the average price. So whenever it is coming here and this is the average price, this point is going to behave like a support, and every time the price comes down from below and is hitting the moving average, this point is going to be considered as a resistance. And hence moving averages actually define support and resistance levels for the stock or the price of the stock. Now there are different types of moving averages. Yeah, there are actually multiple types of moving averages, but we are going to be talking about three of them. One is called simple moving average, second is called as exponential moving average, and third is called as weighted moving average. Very often people use simple moving averages and exponential moving averages. They are the most widely used ones. Sometimes people do use weighted moving average, but exponential moving average just about does the same job. So again, let's have a look at this diagram. This is a price chart. This is the simple moving average, which is denoted by pink. This is the weighted moving average, which is denoted by blue. This could also be the exponential moving average. They have the same sensitivity. Exponential or weighted moving averages are more sensitive to the price and hence stick to the price, while simple moving averages are slightly less sensitive and hence they are slightly away. So they are actually more reactive. So weighted moving averages are more reactive. So let us understand how simple moving averages are constructed. These are the daily closing prices for that particular stock. It starts from 11. So on the first day it is 11, second day it is 12, third day it is 13, fourth day it is 14, fifth day it is 15, sixth day and seventh day. Now if you are looking at a 5-day moving average, which is a simple moving average on the first day, then what we are going to do is we are basically going to add the 5 days and divide it by 5. Why 5? Because the moving average is 5, isn't it? And the average price will be 13. Now this price of 13 is going to be plotted on the chart. Now on the second day, how will we construct the simple moving average? We are going to start from the second day, which means you are going to add this price, this price, this price, this price, this price. The first day price will be dropped. So 12 plus 13 plus 14 plus 15 plus 16 divided by 5. Why 5? Because it's a 5-day moving average. So the price is 14. We are going to plot this on the chart. Again on the third day, we are going to start from the day 3. So it is 13, 14, 15, 16, 17 divided by 5. Divided by 5, it comes out to be about 15. So you actually plot this prices 13, 14, 15 on a chart along with the prices and you get a moving average. And when you do that, this is what we see. Now the point to remember about moving averages is that moving averages are lagging indicators. So there is a lag factor involved. The longer the moving average, the more the lag. A 10 days exponential moving average will hug prices more tightly and will actually turn as the prices turn. A 100-day moving average, on the other hand, will take longer time to turn as it represents the data of 100 days. A simple moving average represents a true average of prices over an entire period of time. As we know, market gives more weightage to the news which is coming out current as opposed to the news which has come out in the past, which means the recent events in the market are more important than the past events. Now there is a technique in which you can factor in the recent events, and hence exponential moving average was born. What exponential moving average actually does is gives more weightage to the recent prices in an attempt to make it more responsive to the new information. In simple moving average, all the data is given the same weightage, but in exponential moving average are given more weightage. Exponential moving averages have a less lag because they are more sensitive to the current prices. Exponential moving average will simply turn faster and react more faster to the prices than a simple moving average. So remember that. So a lot of times students come and ask me, so should I use simple or exponential? It is up to you. If you use simple moving averages, they are going to be less sensitive, they will take more time to turn. Exponential moving averages are going to be more reactive, are going to be more fast paced, and they will give you signals much faster. So let's discuss what are the uses of a moving average. Two moving averages can actually be used to generate crossover signals. Double crossover involved one relative short moving average and one relative long moving average, which basically means that you could have a system where you could use a 20 DMA and a 50 DMA, and whenever 20 crosses above 50, it could be a buy signal, and 50 crosses above 20, it could be a sell signal. You could use simple moving averages, you could use exponential moving averages, you could use weighted moving averages. It is up to you. Like I explained, a bullish crossover occurs when the shorter moving average crosses above the longer moving average. A bearish crossover happens when the shorter moving average crosses below the longer moving. Meaning, if this is a shorter moving average, yeah, so let me draw it like this, and this is the longer moving average, and this is the way it crosses. This is crossing over, and this could be a buy signal, and this is also crossing over, and this could be a sell signal. So there are actually people who use this kind of system where the shorter one crosses above the longer one and there is a buy signal generated, and where the longer one crosses below the shorter one and it is a sell signal. So very quickly, let's look at this diagram. The pink one is a shorter moving average, the blue one is a longer moving average. Whenever the shorter one is crossing above the longer one, it could be a buy signal, and whenever in the future the longer one crosses over the shorter one, it is considered to be a sell signal. So actually you could buy here and you could sell here, and you could keep on repeating. Now let us very quickly understand what are the problems with a moving average crossover system. A moving average crossover system, you have to remember, always produces relatively late signals, which means they are going to produce signals after the prices are moved in a certain direction. That's because the system employs two lagging indicators. The longer the moving average period, the greater is the lag in the signal, which means if you are going to use 100-day SMA and 200-day SMA, the signals are going to be coming in very late. But you have to remember that these signals work absolutely fantastic in a trending market. When the market, what does trending market mean? When the market is moving in a certain direction, up or down, it is called as a trending market. But when the market starts moving sideways, it is called as a trading market. So always remember, use moving averages only in a trending market and don't use moving averages in a sideways market or a trading market, because the moment you start using it in a sideways market and a trading market, it produces what is called as whipsaws, and whipsaws are going to eat into your profits. So this is where the market has started moving actually sideways, and as the market is moving sideways, you can see that these are whipsaws which are produced. So in a sideways market, it produces a lot of whipsaws, but in a trending market, it gives you beautiful buy signals and sell signals. So always remember, use moving averages in a trending market and not in a sideways trading market. There are multiple trading systems which you can construct on moving averages, but that is actually very advanced concepts. So thank you guys, thank you for your time, thank you for listening to me. If you have any questions, queries or doubts, do write to me on Facebook at investments.com, or you could write to me on invest-mints at blogspot.in or Funny Fish Market, whichever you choose. Thanks, and do keep in touch. If you think I have been able to value add to you, do like the video and do subscribe to it, because I'm going to make a lot of videos and they are going to be beneficial to you. Thanks and bye again.